Welcome to module number 2, where we are going to explain the eligibility for applying IFRS 19. By the end of this module, you'll be able to explain the key criteria for a subsidiary to be eligible for applying IFRS 19 and identifying situations where subsidiaries can benefit from using IFRS 19, and also analyze some examples to assess the eligibility based on public accountability. The core concept for IFRS 19 eligibility revolves around whether the parent company or the subsidiary itself is a public accountability entity or not. Here is the breakdown. A public accountability entity is an entity with its financial statements prepared in accordance with IFRS for the purpose of external accountability. These typically include companies listed in a public stock exchange or those seeking a public debt financing, for example. A subsidiary can apply IFRS 19 if it meets all of the following criteria. The parent company applying IFRS. The parent company that controls the subsidiary must prepare its financial statements in accordance with full IFRS accounting standards. And the subsidiary itself must not be a public accountability entity. This means that its financial statements are not prepared for external accountability purposes like public trading or debt issuance. And finally, the subsidiary shouldn't operate in a capacity where it holds assets in a fiduciary capacity for a broad group of external investors, such as investment bank managing their clients' funds. So these are the criteria that a subsidiary can apply IFRS 19 if it meets all of these criteria that we mentioned. The parent company must apply IFRS accounting standard when it comes to preparing consolidated financial statements. The second criteria is the subsidiary is not a public accountability entity, meaning that they don't have stock or bond traded in the stock market. And finally, there is no public interest entity, meaning that the subsidiary shouldn't operate in a capacity where it holds the asset in a fiduciary capacity for a broad group of external investors. So all of these criteria must be met in order to apply IFRS 19. Now, let's take some examples in order to assess whether subsidiary can get a benefit from IFRS 19 or not. Let's assume that in the first scenario, we have a subsidiary of a listed company. Company A, which is a large publicly traded manufacturing entity, and Company B, which is a wholly owned subsidiary for Company A, engaged in distribution of the manufacturing goods, and the Company B is not publicly traded and sells its goods solely to Company A. So let's analyze this situation. Company B is eligible for IFRS 19 because it meets all of the criteria regarding the parent, which is Company A in our situation, applies full IFRS. So this first condition already met because the Company A applying the IFRS, full version of IFRS. And Company B itself is not a public interest entity or a public accountability entity, meaning that their stock are not traded in the market. And the Company B doesn't hold assets in a fiduciary capacity for external parties, but they are only selling goods solely to Company A. So in this case, the subsidiary met all of the conditions, and the subsidiary can benefit from IFRS 19 reduced requirements for disclosures. Now, let's take another situation and scenario and assess the company in this case. Company F, which is a subsidiary that holds a portfolio of investments on behalf of its parent company. The eligibility of Company F depends on whether it holds these investments in a fiduciary capacity for external investors, which means that if Company F simply manages its parent company's investment portfolio, it might be eligible for IFRS 19. However, if it holds these investments on behalf of a broader group of external clients, it wouldn't qualify to get a benefit from IFRS 19 because in this case, it would act as a public accountability entity because it acts on behalf of a broader group of external clients to manage their funds. So this is how to analyze each situation in order to assess whether a subsidiary is considered as a public accountability entity or not. Now, what are the benefits of applying IFRS 19? For eligible subsidiaries, applying IFRS 19 offers several benefits. As we discussed before, this will reduce the compliance cost because less complex financial reporting requirements will lead to lower accounting and auditing fees. And IFRS 19 will provide reduced requirements for disclosure and reporting. And IFRS 19 also will result in simplified financial statements because more concise presentation allows for easier internal analysis for decision making. And finally, it will increase the efficiency because a streamlined reporting process allows for faster financial statements preparation. So the conclusion here for this module that by understanding the eligibility criteria and the advantages of applying IFRS 19, companies can determine if this simplified reporting framework is suitable for their subsidiaries without public accountability. So first things first, the parent company must assess whether one of its subsidiaries is being considered as a public accountability entity or not. And if it is not a public accountability entity and they meet all of the conditions, so in this case, this subsidiary will be eligible for applying IFRS 19 and they get a benefit from the simplified reporting requirements under IFRS 19. In the next module, we will delve into the specific area where IFRS 19 offers reduced disclosure requirements compared to the full IFRS. Stay tuned and join me in the next module.